Thank you for tuning in. This is Shakama from Blog TV, your host, Kevin Cardinale. Today I'm going to talk about the US dollar and the possible and very realistic decline of the US dollar. Let's go over some history briefly. Comparatively speaking, today's US dollar compares to the 1812 as 1 cent, 1912 as 2 cents. After 1971, when we went off of the gold standard, that's right, we are no longer backed by gold. The US dollar is no longer backed by gold, contrary to what some high school teachers are still teaching kids. You saw a decline in the dollar. With the advent of the Federal Reserve, a privately held bank, in 1913, it ended 100 years of dollar price stability. We have a budget and trade deficit of 1.5 trillion. Feds have the Treasury Department print up 1 to 2. Comparatively speaking, the Dow Jones, compared to the pricing of gold, has declined massively and directly proportionately to gold since 2001. From 1776 up to 1980, we accumulated $8 trillion in debt. From 1980 to 2007, it went from $8 trillion in debt to $44 trillion in debt. 27 years versus 200. 1944, world monetary currency was elected to be. However, due to recent events and a 32% dollar decline since then, large dollar holders are now exiting the dollar, namely Asia and the Middle East. They're moving towards the euro. We would need to happen for a dollar collapse would be for Moody's, somebody like Moody's, to simply downgrade some of the financial papers. See a massive dumping of the US dollar onto the market, which would plummet the currency rate. As I said, there is a huge move to euros now. Let's take a look at some other numbers. From 1776 to 1980, the annual debt was $1 trillion. From 1907, the debt went from 1 trillion to 1 trillion. Now, let me talk about the housing crunch and how that ties into U.S. housing mortgages debt $4 trillion to $8.7 trillion from 2003 to 2007. Just 4 years. More than double. Household debt, that's credit cards, loans, are at a growth rate of 10 times household income. And the Federal Reserve and the government have continuously had a campaign to entice consumers to borrow and spend more. And why could that be? Because the world market depends on U.S. consumption and buying. Any stop will plunge the world into a recession. Get back to housing. The ARM mortgages due in 2006 were predicted to be $1 trillion. $1.7 trillion. Rate would adjust to an increase of 25% to 100%. The actual highest real estate and foreclosures and drops actually occurred in the Midwest, where there was no perceived housing bubble like others have. During the real estate boom, it caused homeowners to use their home as cash cows, taking out trillions of dollars in debt. And that accounts for 68% of all U.S. households. Over the last 6 years, 30% of all employment was directly related to housing, construction, and brokers. Layoffs created a national crisis. Currently, a current trend is to accelerate delinquencies, defaults, and foreclosures. This is predicted to continue as a trend up to 2012. 2005, household income rose 1.2%. Household debt rose 11.7%. Now, why do we have such a discrepancy, or why do we have such a concept going on? The Federal Reserve, privately held bank, which is unconstitutional, after the dot-com $8 trillion collapse in the 1990s, moved to prop the economy to avoid the recession back then, to keep Americans borrowing. And as a result, for instance, you'll have subprime loans where you'll have no money down and you're only 5% into the house, and then because of the house drop, say 10%, you are now upside down in your home. Home equities loans were used as cash. 40% of all homes in 2005 were bought by investors for a second and third home. With that gone, it led to a giant deficit in the housing market also. We can expect realistically a pricing fall of 30% to 50% in real estate, with 50 to 80% in severe areas of where the housing bubble was massive. The inevitable collapse of the dollar, Nobel Prize winner Dr. Paul Samuelson predicted a run on a dollar and a global financial crisis in 2005. Peter Schiff is even quoted that Asia is supporting us, but as soon as they find that they can do better without us, they will dump us, which will also plummet the dollar. The only reason the US dollar hasn't been replaced up until recently was due to liquidity of another currency. The euro is now capable of being as liquid as a US dollar, with trillions of euros being available on the market. Seeing that we are borrowing $3 billion each day to keep the economy afloat. There is no politician, no congressman, senator that is telling anybody to save their money and to stop spending. They are all saying the exact opposite. And you might be asking yourself, why? Because of foreign investors. Housing bailout and the Wall Street bailout was not to save American investors, it was to save foreign investors. If you think that you are electing somebody who is speaking for you, you're sadly mistaken. Please save your money. Stop purchasing needless items. Save your money on food. Get a food budget. And live within your means. And put your money into savings. Because we're not going to have all social programs continue as they have been. This has been Kevin Cardinale, and thank you for listening.